Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Today's video is going to be about Molson Coors, the stock symbol TAP brewing company. And I'm using it as an example that was inspired by a subscriber who asked for a very specific question on how we utilize the FastGraph fundamental analyzer software tool, specifically things like fund graphs, the fiscal fitness section, as well as the financial statements. So in the video, I'm going to go over the company's fundamentals, basically like I normally do, and look at it as a deep value play today. I'm also going to look at it from a standpoint of fiscal fitness and fund graphs. And then I'm going to have Colton, my son, come in and go over the financial statements to look for the things that might have caused some of the issues that you're going to see with certain metrics as I go through them. So let's go ahead and get into the fast graphs. But before I do, let me read you the statement from the subscriber. The subscriber's name is Martin Curell, and he said, "Chuck, I have a serious question. Could you show us, your followers and subscribers, how you work with financials, fund graphs, and fiscal fitness? I am sure many of us would really appreciate it as another piece of analysis, and with your experience, it will be another superb thing to learn. I am sure you would do it as interesting as you do your other thoughts and teaching on identifying company overvaluation, undervaluation, or within value. I appreciate your time and thinking, et cetera, et cetera." So bottom line is, I'm going to go ahead and go into the fast graphs now and look at Molson Coors Beverage Company. Now, as I usually do, I'm going to take the price off of the stock for a minute, and I'm going to look at the operating earnings. Now, there are two lines on this graph that you can maybe only see one, some of you. There's a blue line, which is the normal PE, and then there's the orange line, which is the operating earnings. Those two lines happen to be almost superimposed right now. In other words, this company has typically and normally traded at around a 15 PE. And the 15 PE is using a formula to value a business, utilizing discounted cash flows analysis, is basically indicating that this would be the fair value of this company given these growth rate achievements. Okay, so I'm going to move into the graph here a little bit, and I'm going to talk about what you're seeing. Well, first of all, you're seeing that earnings had dropped in 2005, and then coming into the Great Recession, we saw a flattening of earnings. But coming out of the Great Recession, we saw a big increase in earnings. And then we kind of had flat earnings growth, as you can see by looking at this change per year earnings here. And then we had a little bit of a surge in earnings for a couple of years. And then we came into COVID, and the gold line on the graph is the company's dividend, and the area below the gold line is the payout ratio. So you can see the company's normally paying out 35 to 40%-ish of their dividend, but management and the board, I guess, decided to cut the dividend in 2019. Now note how you see that just instantly by looking at the fast graph. You see good solid dividend growth all these years. Then we see a sharp decline. The dividend went from $1.96 to 57 cents. Then they raised it back to 68 cents in 2021. And then they've been raising the dividend again for the last 5 or 6 years. Okay, now when I put weekly closing stock prices on the graph, I want you to see the valuation anomalies that the market will typically create. People have to realize and understand that the market does not always price a stock according to its value. And if you want to participate in what the stock has to offer, what the business has to offer, you got to buy the stock at or below its fair value. It's really that simple. So here's a period of time coming into the Great Recession. The PEs got up into the 20s, 21.3 on October 26th. And then we can go all the way out here, and I'm going to hit just about the very bottom. We're going to go to November 16th, 2012. We're looking at 5-ish years here. And there were dead money on this stock, even though we had pretty good earnings and we had dividend growth. But the problem was overpaying for the stock led you to actually lose over 30% of your value on the stock price because you paid a high value for it. Now, had you bought the stock at a better value even a year or so before and held it through basically that same time frame, you'd actually eked out about a 6.57% rate of return. My point being is that valuation matters a lot. But I also want you to note that historically, the market went through a period of time for a couple of years here coming into the recession where they overvalued the stock. Then they undervalued it for 7 years. And then for whatever reason, they got excited about it again and ran it back up to these 20 multiples. And of course, that once again turned out to be a horrible time to be buying the stock. If you were buying the stock at any of these times, you were losing money owning this stock as a long-term investment. And that's despite the fact that the company's operating results were pretty good. Now, of course, they did struggle during COVID, and they did cut their dividend. And if you look at the stock today, it's trading at a blended PE of 8.38. It has a strong earnings yield of almost 12% and a very attractive dividend yield of 3.78%. It only has 32% debt to capital. So if you bought that stock today using the summary page of Fast Graphs, and the stock moved back to a 15 PE, like we talked about, it had typically traded at over this whole 20-year period. You can see that by adding the normal PE has been around 14.57. That would indicate an opportunity to make 34% annualized rate of return out to the end of 2027. The stock is very, very cheap. Now, if we used the normal multiple for the last 5 years, which has been even lower than historical norms of 11, now you're still looking at an opportunity to make over 21%. And I guess the point is, if I go back into the historical page here now and go into forecasting, and if I look at the normal multiple, if it traded at the 14 PE, like we've seen historically over time, we would have a chance to make almost 34% annualized. So there is an opportunity here, but the opportunity is really in the fact that earnings have begun to advance again. We are expecting a down year in 2025, which could be why the stock has fallen, but we're expecting decent growth going forward based on the historical norms of the company. So if you were wanting to invest in Molson Coors Beverage Company, now would be appears to be an excellent time. But let's look at some other things. One of the questions I always get is, why are the PEs on my videos different? Well, for one thing, we're using the adjusted operating earnings metric. Sites like Google Finance and Yahoo will often report PE ratios based on diluted earnings. Now, in Molson Coors, they happen to be pretty close to the same number. But oftentimes, if you get these one-time charges, non-cash events that come with diluted earnings, which is GAAP earnings, you can see a totally different picture. But when you're looking at valuing a business, adjusted operating earnings are really the go-to number. That's what really drives market price more than the diluted earnings, which include all these crazy charges. Now, since this is a dividend-paying stock, I also want to look at it from an operating cash flow point of view, and I'm not so much concerned with price here as I am concerned with, do I have cash flows, which are the orange line now on this graph, because I'm looking at operating cash flow. Is the cash flow higher than the dividend? And you can see that by looking at this table here. In 2010, we had $4 of cash flow covering a $1.08 dividend. I also like to look at free cash flow to equity, which is what's left over after spending the money to run the business. And Coors also has a free cash flow to equity that basically covers a dividend. But note that the free cash flow to equity was dropping coming through into the COVID era, and it dropped for several years after COVID. And this is probably what instigated or inspired the board and the management to cut the dividend to protect themselves from deteriorating fundamentals. Okay? Now, I also like to look at other metrics when I'm analyzing a stock, and Fast Graphs lets me do. I can look at EBITDA, and I often like to price a stock when I look at EBITDA, and you can see kind of a relationship between EBITDA dropping and the stock price dropping. I also like to look at net income or EBIT and see what's happening with the stock, and so I can also look at, and it looks good, in this case, very close to EBIT, but then I also like to look at a company's revenue or top line. The sales growth of the company did splurge in 2019, and perhaps that explains some of these high valuations, but it doesn't to me when I'm looking at this quickly. So anyway, I go through this process and look at these stocks with all these different metrics. But the question I got was, when I look at a company, what do I do with fund graphs and fiscal fitness? Okay, now what these are shortcuts to help me determine whether or not the company appears high enough quality for me to want to invest in it. I like the valuation here, and I like the return potential based on the fact of this company eventually reverting to the mean, moving back into alignment with fair value. The growth here is moderate. We're only looking at forecast growth of under 4%. But the leverage comes from the stock moving back into alignment with a higher multiple than it's currently trading at, which it historically, when I look through the stock here, it has historically traded at higher multiples than it's currently trading at, almost exclusively. In fact, we do have this line where we have the current valuation line, where I can draw a line through the last closing price, then run that valuation all the way across the chart. And what I see here is that there was only one other time, and that was during COVID for almost a year here, where you could buy this Molson Coors at such a low valuation. So this is an extremely low valuation for this company. And I'm utilizing this information for FastGraph. But now let's go into fiscal fitness and let's see if there are any red flags on the fiscal health or financial health of the company. Now, I like to look at free cash flow covering the dividend, which I've already done. I like to look at operating cash flow growth, and we can see that it's a little spotty here. There are times when it was growing very strong, but coming through COVID, once again, we see that period I highlighted earlier where we had operating cash flow dropping, but it looks like it's recovering again. Now, share buybacks is critically important. I like to look at share buybacks because if I look here, I can see that Molson Coors was maintaining their share count more or less for all these years here coming out of COVID. But then from 2015, they actually issued some shares. So if I go to the historical graph and look at 2015 and 2016, I see that that was a period when their stock value was extremely high. Now, on that basis, I like to see a company issuing shares when they can get a lot of money for their shares. Okay, because they're raising capital when they issue shares and they're maximizing the capital. I don't want to see a company buying stock back when their price is high like this, because if they're buying their stock when the share price is here, they could be destroying the capital that they invested in the stock. I only want to see a company buying back stock if I'm willing to buy back their stock. And so going back to fiscal fitness and looking at share buybacks, they did buy back a pretty substantial amount of stock in 2024. And once again, I like that because 2024 saw these very low valuations on the stock. So they're buying stock back when it's cheap. Now, fiscal fitness just alerts me to that by going to share buybacks. Again, I talked about operating cash flow being greater than net income, and it has been in most years. Net income number is the gold bar, and the red bar is the net operating cash flow. And I want to see the cash flow higher than the net income. But then we did have a period. We had a period in 2020 here, and again in 2022, where the net income actually turned negative. Now, we did have operating cash flow greater than net income, but net income turned negative. And looking at sales revenue has been relatively consistent, if not growing a little bit in these last several years here. Okay, and I go through all these. Now, the other one, but I'm not going to go through them all just for sake of time in the video. Let's look at margins. Margins have been relatively stable on a gross basis. And there are times they drop a little bit, but we've got good margins in the 30 to 40% range most years. The operating margin has been double digit. It's double digit again the last couple of years. But once again, we get into net margin, and we see that net margins since 2016 and through COVID shrunk dramatically and even turned negative again in 2020. Okay, and then we saw negative margin in 2022. Okay, now those are red flags, and those are things that I want to think about. Now, I can look at return on assets and see a very similar picture. I can look at return on equity and see a very similar picture. And I can look at return on invested capital and see a very similar picture. So something's going on here. What this does is it raises questions for me. Now, I can also go into fund graphs, and I can do a lot of the same work. Fund graphs have just been really updated. And one of the things I like about fund graphs, and we'll be improving on this, and I want subscribers to know, we're going to be giving you what we consider to be with these preset charts, the quick way to look at the company. You might even ultimately replace fiscal fitness. But there are things in here you can look at, like the cash flow breakdown, and that includes capital expenditures. So you can look through here and see, has there been any real change in capital expenditures going in the year? So this would give you some insights into how much money the company's spending on keeping their business going. And then we can look at free cash flow to equity. So we have these areas here that we can look at. We can also, and Colt just did a video on this, so I'm going to let you go to that video, but I will go through fund graphs and go through some other very important metrics that I think are important. But then ultimately, once you've identified things like going back into the fiscal fitness here, once you've identified weakening returns on capital or assets or equity, and you've also seen weakening margins, well, then there you would go into the financial statements and you would go into the company's financials. And when you go into the financial statements, you can look at the income statement, the balance sheet, the cash flow statements, and look for clues. I've asked my son Colton to go through the financial statements here on Molson Coors and see if he can find clues as to why we've had those issues with net income and lower returns on assets, et cetera. So let me turn it over to Colton.
Hey everyone, Colton Carnevale here. So as Chuck said, we're going to take a look at the reasons why margins were negative for this company, as well as return on equity, return on assets, everything like that. And that has to do with some negative net income values here. So what we'll do is you can really uncover this if you click on the financials tab, and we're specifically going to look at the income statement. What I'm going to do is drop it down some years. That way we're only looking at some of this more recent data. And I always like to start on the bottom up. So coming down and discovering the value that we're ultimately looking at, net income, and then working my way up the financial statement to take a look at this. So notice you also have some charts here, so we can also take a look at some of these values to make it easier. So we know that net income's negative here and here. We can see that. So this is reasons why that return on assets, return on equity, all of those things would be negative values, and then why margins would be negative at this point. But as we work up the financial statements, we'll start to see why. So the next thing I like to take a look at are sales figures, right? So looking at these sales figures, we can see they're somewhat in line. There's some growth, also some drops here. So just taking a look at this, we can see that for one thing, sales dropped during 2020. So they're already making less money. And we know that 2020 is one of the years that we saw negative net income. Same with 2022. So sales dropped during this time. Now sales grew to 2022, and we'll investigate more why this happened. And then we can take a look at next thing like cost of goods sold as to see how these values have moved. But one thing that I actually really like to look at now that I've looked at how the sales numbers have moved is clicking this button up here where it says view absolute. What I'm going to do is change it as a percent of revenue. So that's going to turn basically everything on this page as a margin. So I can see how much of sales these values are representing. One thing I'm going to do is go ahead and close a lot of these just to make it, we're looking at kind of the larger numbers, and we can now see all of them on here at one time. So looking at 2020, I can see that the cost of goods sold somewhat increased during this time. It actually shot way up during 2021 to 66 and shot way up to 68% in 2022. I can uncover that here using these values as well. So for one reason why we already know that net income is going to be affected just by the cost of goods sold increasing during this period. So these would be some items that I would take a look at in the financial statements, in the notes to the financial statements as to why they did. And you can always click on here and go directly to the 10K for these years and do further research on this. We're not going to do that in this video. That definitely requires a lot of time to do that. But what Fast Graphs is showing you is the points that you can start to look into. Now, next thing we can do is pop down to the operating income and see the operating margin of this company. So I would say that 2020 was in line. We're pretty good here compared to these other years. So this isn't a major reason as to why 2020 had a negative net income. But as I start to look down this line, I can see unusual expense had a huge value. During 2020, they definitely had some massive value of unusual expense. I can change this back to absolute and take a look at this. So they had a 1.7 billion charge in unusual expense. So this would be something that I would immediately go look at, or at least note right now, and then use some other sources to go find this, like the 10K or even talking to some AI tools that are now widely available, like ChatGPT, to start to discuss what happened to the company during this time. So we can see that the company went negative during 2020 due to this unusual expense. And I did some research before this. It happened to be a goodwill impairment charge. So this is a non-cash charge. This is a GAAP accounting procedure. So the company didn't really lose money during this time. It's just something that affected the income statement. Now we can go back and take a look at the percent of revenue again. The next one we are going to be looking at is 2022 as to why we have seen this negative net income during this time. I'm going to go ahead and close all of these again. I kind of alluded to before, we saw a huge increase in cost of goods sold. So we went from like kind of a baseline of 13 to 14% of EBIT, operating income, down to 9%. And then on top of that, we had another unusual expense of 8% that year, which then brought the pre-tax income actually negative at that point. Then coupled with taxes, gave us a negative net income. So the company has obviously recovered since then. They've had positive years of income, and I can see their cost of goods sold have normalized during these times. I can see that their EBIT has once again normalized during these times. So the company has recovered. But what this allows us to do is kind of take apart the financial statements using some of these things like percent of revenue, these graphs that we have on the side here, and then even linking to the financial statements to dive a bit deeper and figure out why those numbers changed exactly. So Fast Graphs gives you the ability to kind of hone in on what you need to look for when diving deep into the financial statements using these tools. And when I say financial statements, I mean like the 10Ks and the 10Qs, actually going and looking at the published statements of the company, because that's where you'll really find the detail and figure out exactly what happened. But using percent of revenue is an extremely valuable tool. It turns everything into this margin to where now you can kind of analyze instead of just looking at whole numbers, which can be a bit confusing and doesn't really give you a comparison or a reference view of it. I can now see where the numbers actually made the largest impact on the financial statements.
Okay, thanks, Colton. Appreciate that. Now, what we've done here with the Fast Graphs is we've looked at, in this case, Molson Coors Beverage Company, symbol TAP, and we've evaluated it looking for reasons why the stock price might be so low. And it is a very high valuation play. But what Fast Graphs does is it really gives you the opportunity to determine whether or not you want to research the stock further and faster. Now, we went through the historical graphs, all the various metrics. We went through fiscal fitness and utilized fund graphs a little bit. And then I had Colton go through the financial statements so that we can discover whether or not we should go further with the stock or not. I think the stock is undervalued at this point, but I'm going to let you decide whether it's an investment that you would want to consider spending more time on. Thanks for watching. If you liked the video, give me a like, subscribe to the channel, and of course, subscribe to Fast Graphs. It is such a powerful tool that can help you really make smarter, more learned, and more profitable, ultimately, investment decisions. Thanks for watching.